Hello and welcome to another stock analysis on Stock Market Palantir. Don't forget to put your comments and subscribe. Okay, now let's go hear our analysts.
Welcome to the Stock Market Palantir. Today we are going to talk about PL, Planet Labs PBC. This company has really become one of the defining stories of the whole Space 2.0 economy. It's moved from being, a niche geospatial data provider to a recognized critical infrastructure player. We're focusing today on the intense repricing that happened right after they released their Q3 fiscal year 2026 results on December 10th.
The numbers really do tell an incredible story of reversal. I mean, the stock is trading right now around $12.94, and it's seen year-to-date gains of over 220%. But the real spectacle, I think, was that volume surge. Daily trading volume went from a pretty sleepy 6 to 10 million shares to over 28 million on December 11th. It fueled an intraday rally that stretched somewhere between 17 and 36%. The market just fundamentally changed its mind on Planet Labs in a single day. I agree that the market's perception has changed violently, but the key word there is violently. So the central question we have to tackle is this. Does this explosive price action primarily reflect a sustainable, a fundamentally justified turnaround story, the genuine realization of their potential? Or is this massive repricing largely an unsustainable speculative bubble? Something fueled by, let's say, market microstructure mechanics and just extreme retail momentum. My stance on this is pretty firm. I think this movement is fundamentally sound, it's justified. This Q3 result was the crucial prove-it moment that validated the long-term thesis, and frankly, it significantly de-risked the company. I believe we're seeing the start of a sustained ascent toward a much, much higher enterprise value.
And, I have to respectfully disagree with the magnitude of the move. I believe the sheer scale of the appreciation is disproportionate to the underlying fundamental news. I think it's more of a mechanical anomaly, a massive valuation squeeze that happened when excellent news just collided with a highly leveraged market structure.
Okay, let's start with the operational engine that really ignited this. Q3 revenue was $81.3 million. That translates to a massive 33% year-over-year growth. That's not just growth. That's a clear acceleration from the 20% growth we saw in Q2. But I think the most important metric, certainly for institutional investors, was the achievement of positive adjusted EBITDA. $5.6 million.
Definitely the critical proof point. For those listening who might not track every single high-growth tech stock, achieving positive EBITDA, that means they've successfully crossed the valley of death.
Exactly. The valley of death is that perilous phase where cash burn for expansion just outweighs your funding capabilities. You risk massive dilution or even insolvency. Crossing it just fundamentally changes the risk profile of the investment.
It does, but let's look at why the valuation multiple exploded. The reason the stock suddenly entered that high-flying tech bracket is because the company is now hitting the coveted Rule of 40. That 33% revenue growth plus a roughly 7% EBITDA margin, the $5.6 million on $81.3 million in revenue, gets them just over that 40% threshold. And that is the metric that justifies a premium software-like valuation. My point, though, is that the market may have prematurely given them the highest possible premium.
I think the premium is justified by the quality of that revenue, though. This isn't just, generic sales growth. Their defense and intelligence sector, D&I, grew 72% year over year. These are sticky, mission-critical, high-value government contracts, like the NGA Luno B agreement. Geopolitical volatility basically ensures these contracts are reliable, predictable, and they grow regardless of economic cycles. That alone warrants a high multiple.
That predictability provides a fantastic floor, I'll concede that. But I think focusing only on the fundamentals risks obscuring the powerful and frankly volatile market mechanics that actually drove the price from $9 to $13+. My skepticism really centers on the market microstructure.
How so?
Well, the magnitude of the movement. It just points directly to a mechanical failure in the short base. Total short interest was substantial, sitting at about 35 million shares. And crucially, the liquidity to cover those shorts was basically non-existent. The days to cover metric was critically high, ranging between 4 and 6.5 days. For anyone unfamiliar, days to cover is just how long it would take short sellers to exit their positions, given the average daily volume. Anything over 3 days suggests a statistical short trap. So when that Q3 news hit, those trapped short sellers were instantly forced into a rapid, indiscriminate buying spree.
Short covering certainly provided the initial combustion, I'll give you that. But it doesn't explain the sustained accumulation afterward. If it was purely a forced squeeze, that capital would evaporate pretty quickly.
I'm sorry, I just don't buy that the initial violent lift wasn't almost entirely mechanical. Let me expand on the plumbing here. We can look at the dark pool liquidity data. On December 1st and 3rd, the off-exchange short volume ratios were spiking at 57 to 58%. This indicates that market makers were aggressively shorting to provide immediate liquidity to institutional long buy demand that was coming onto the exchange. So this dynamic, it creates a massive coiled spring of underlying bullish pressure in the market's background. And once the Q3 news hit, that spring just exploded, forcing the market makers to cover their short hedges immediately, which compounded the squeeze from the retail and hedge fund side.
That is a serious point, detailing the setup for volatility, but I think we have to ask whether the market structure sustained the buying or if it just accelerated a trend that was already confirmed by fundamentals. I see why you're emphasizing the mechanics, but the technical analysis suggests the buying pressure is now sustained and, validated by sophisticated institutional capital.
Okay, what have you seen technically that confirms sustainability above $12?
We've established a bull market regime. We've hit what technical analysts call the golden cross. And this isn't some mystical alignment. It's a technical confirmation of a robust, long-term trend shift.
Could you maybe clarify that for the audience?
Absolutely. The golden cross happens when the short-term moving average, that's the 50-day moving average, crosses decisively above the long-term average, the 200-day. This confirms that the average price buyers are paying over the last 2 months is now higher than the average price over the last 9 months. It signals that long-term institutions are initiating new, sustained positions. It suggests this is a regime change, not just a temporary blip.
I would argue that technical indicators like that often lag the underlying mechanical reality.
Perhaps, but you have to consider how the market absorbed the supply. We saw significant insider selling, including $3.1 million sold by CEO Will Marshall. If this rally were fragile, if it were purely a mechanical squeeze, that supply from the CEO would have triggered a sharp correction. But it didn't. Institutional demand just absorbed that selling without a meaningful price drop, which is a hallmark of robust accumulation. And furthermore, we need to address the data on settlement failure.
You're referencing FTDs?
Yes, failure to deliver data. If this were a classic, manipulative, or purely synthetic short squeeze, one that's reliant on trades that couldn't settle, we would see a massive spike in FTD data in the current period. The absence of widespread FTDs indicates the volume driving this rally is genuine, settled volume. This makes the price action far more durable than one driven by mechanical settlement stress.
Durability aside, let's talk about the absolute ceiling of rational valuation, which is my core concern. You are paying a massive premium for future potential, not current financial results. Even if we use reductive methods, the valuation is stretched beyond belief.
And I assume you're referring to the discounted cash flow models.
Exactly. Strict adherence to traditional DCF models, it calculates a fair value near 27 cents per share. That is a truly shocking number. It implies the current price is a premium of over 4,000%. Now, I do acknowledge this model is flawed here.
And why do you think it's flawed?
Well, the DCF model is inherently reductive, and it really struggles with companies that have extremely high upfront capital expenditures before they generate substantial cash flow. I mean, Planet Labs had to spend billions building that massive satellite constellation before it could monetize the data. The DCF model punishes that heavy capex. But even if that specific loan number is inaccurate, the fact that a standard valuation method yields such an extreme disparity, it just highlights the massive valuation risk inherent in the current price. A price-to-sales ratio of 13 times is highly extended for a company only recently achieving a positive EBITDA of $5.6 million.
But I'm just not convinced by that line of reasoning because it focuses on a highly traditional, maybe even archaic, view of value for a strategic platform-level data company.
Traditional metrics completely fail to capture the monopolistic data asset they possess. Planet Labs operates the largest constellation of Earth observation satellites. Replicating their historical archive would literally cost billions of dollars and take decades of lead time. That is a massive, tangible moat. You're not buying a physical asset company. You are buying proprietary, irreplaceable data infrastructure.
But 13 times sales means you are pricing in zero execution risk.
We are pricing in the strategic optionality inherent in that data moat. This includes what many analysts are calling the AI optionality. The data archive is the fuel for machine learning models that can create a Google search for Earth, providing insights at a scale and speed that no one else can match. That capability warrants a premium, software-level multiple, pushing the bull case fair value, in my view, closer to the $14.50 to $22 range.
I appreciate that the potential is immense. I really do. But the market has to recognize the difference between high potential and high valuation. Being priced for perfection leaves no room for operational setbacks. What if there's a delay in launching a new constellation or a slip in key D&I contract renewals? The market will correct violently because every single future success is already baked into the stock price. Yes, the $677 million cash position is a fortress, but the long-term cash generation rate has to eventually justify this enormous enterprise valuation.
The foundation of that cash generation rate is sound, though, particularly because of what I'd call the geopolitical put, the reality that governments are pretty price-insensitive buyers of intelligence when they deem it mission-critical. That 72% D&I growth is the evidence that the monetization engine is reliable.
Even reliable engines can be over-revved by speculative capital. We can't overlook the dramatic role of retail insurgency in generating this volatility. Ah, you mean the return of the meme stock dynamic? Precisely. We are witnessing the resurgence of Planet Labs on platforms like our Wall Street Bets. We saw the shift from loss porn, where users posted screenshots of massive underwater positions, to gain porn, which drives traders motivated by pure high-octane FOMO, the fear of missing out. And that capital is incredibly fragile.
I absolutely acknowledge that retail sentiment acts as an accelerant. It enhances volatility and liquidity.
It's more than just an accelerator, though. The momentum is based on rotational, non-fundamental logic. Retail traders see PL as part of a space basket, and they're rotating profits from perceived leaders like Rocket Lab or Lunar Outpost into PL, chasing the laggard that suddenly woke up. They're trading based on gap-and-go setups and chart patterns, which is inherently less sensitive to valuation multiples. And this adds a layer of significant non-fundamental fragility to the price structure.
That logic introduces massive volatility for sure, but the underlying direction was set by the Q3 fundamental catalyst. Retail capital is riding a legitimate wave, not generating a fake one. The 33% revenue growth and the EBITDA profitability provided the foundation. The difference between PL and prior pure meme stock events is that PL has that strong underlying foundation of high-quality D&I contracts, providing a safety net. This is hype attached to a high-growth, mission-critical utility, not just hype attached to a failing business.
And the question for every investor today is simply, how much of that $12.94 price is the durable utility and how much is the mechanical overextension? I maintain that while the direction was set by the earnings, the extreme amplitude was dictated by the microstructure squeeze and the subsequent retail FOMO. Ignoring the mechanical component is, I think, a recipe for being caught flat-footed when the momentum inevitably shifts.
And that is the core tension we wanted to illuminate. PL's dramatic price surge is either the definitive beginning of a sustained ascent, validated by strong Q3 fundamentals, especially that revenue acceleration and achieving positive EBITDA, or it is a temporary microstructure-driven overextension amplified by speculative retail momentum and the mechanics of trapped short sellers. My view remains that Planet Labs has officially emerged as a profitable, mission-critical data utility for the AI and defense age, and that justifies the premium commanded by its unique data moat.
I acknowledge the truly impressive operational turnaround and the fundamental de-risking of the business. I do. However, I must warn that the current price level carries extreme valuation risk. Investors need to recognize the significant component of mechanical, non-fundamental buying pressure that has driven the stock to its current height. It leaves very, very little margin for error should operational hurdles arise.
A fascinating tension, as always.
Indeed. Thank you very much for hearing us. Let us know in the comments what is your opinion and if you want us to analyze other stocks. Don't forget to subscribe to the Stock Market Palantir channel to catch up with more stock insights. And see you in the next video.